keynote speaker today, Andoni Nicolai, is head of Jaltech Digital Asset Operations. Andoni studied BSc Actuarial Science and Statistics at Wits University. I always describe Andoni to people who I'm introducing him to as an experienced expert in the crypto ecosystem with 5 years experience, which in the crypto space is a lifetime. Andoni, thank you for joining us, and over to you.
Thanks very much, Mike. You always flatter me with those intros, but I'm glad you think highly of me. So right, without further ado, I'm going to jump straight into the presentation. So what I would like to achieve from the presentation today is to give viewers a basic understanding of what is the blockchain. And you know, there's wide-ranging views, there's exotic explanations, but I want to try and distill it down and simplify it to its essence so that you can actually understand what it actually is. Is the space regulated? What is the guidance given on crypto assets? Is it completely unregulated or regulated? We'll jump into that. We'll understand what currently exists and what we think might come in the future. And then also a little bit of a discussion on what are the risks that are inherent in this market and how do we mitigate them, and what are the opportunities. So dealing with the technical stuff first. Before we can conceptualize a blockchain, we need to define a few things. Firstly, we need to define what a ledger is, and we then need to differentiate between centralized and decentralized networks. So the basics, a ledger is simply a time-stamped record of transactions or financial accounts. You know, everyone understands what that is, right? And traditional finance, such as banks or insurance companies, all operate with centralized ledgers. So an FNB, a Standard Bank, a Discovery, anytime you have an account with them and you want to query how much money do I own, what's my savings account worth, how much interest have I earned, you send a query to that centralized institution who then checks their ledger and they then give you that information. Now, traditional online services are also centralized. The big tech giants like Google, Facebook, YouTube, they are all centralized online platforms. And anytime we use their platform, we're using it at their discretion. If any of them decide to censor us or kick us off, or you make, you know, you put the wrong post on your Facebook account, you can be banned from those platforms. And that's as a result of them being centralized, because there's one point that controls that platform or that network. Now we need to try and conceptualize, we need to move out of that framework of thinking, and we need to try and understand how a decentralized network would work. And these networks started emerging in the late 90s, early 2000s. Anyone who's ever used a content sharing site such as Napster or LimeWire, or anyone who downloads content using torrents, these are examples of decentralized networks. So instead of querying one centralized server, you can query any peer that is connected to the network. Again, I'm going to try not to use too much jargon, but a peer is quite simply a node or a computer that's connected to the same network and that is copying the same ledger. So if I could distill all of that down into one sentence, okay, and to answer what a blockchain is simply a decentralized ledger that follows a specific set of rules and is maintained by every single peer that is connected to the network. So if a government wanted to shut down a network, if they wanted to shut down YouTube, for example, they simply need to locate that central server and they need to destroy it. And then that would be the end of YouTube. But now, in a decentralized system, if someone wanted to shut it down, you would have to locate every single peer that's on the network, and these peers could be distributed globally, and you would need to destroy every single copy of the ledger before you can shut that network down. So with these two comparisons, you can see that decentralization has the benefit of being robust, transparent, and trustless when compared to traditional centralized networks. So hopefully that gives a high-level understanding of what a blockchain is. Again, this is an introduction, so I don't want to get too technical. Future webinars might go deeper and get more technical, but I want there to be the understanding that a blockchain is simply this network that exists in multiple different locations at the same time, and it's communicating and storing the same transactional data. So that's all fantastic, but what can they actually do, and why are they gaining so much value? Cryptocurrencies have a very wide set of potential applications. We are seeing a lot of real-world use at the moment, but a lot of applications are still concepts and may only come in the future. But these applications can range from currency, non-sovereign money, such as Bitcoin, which is a competitor to national currencies, to decentralized lending markets, decentralized file sharing, so something that's analogous to OneDrive or Dropbox, which are centralized file sharing services. These can be replicated in a decentralized way, all the way to cross-border remittances, micropayments, supply chain management, and even digital art in the form of NFTs, non-fungible tokens. And again, I'm not going to go too far into NFTs and a lot of these buzzwords. These might be saved for later webinars where we do a deeper dive into those specifics. So essentially, though, what we are seeing happening is that any financial service and almost any digital platform that we currently use that is centralized has the potential to be disintermediated and recreated on a decentralized platform. What's also very important with these networks is to differentiate between native blockchain currencies and tokens that are built on top of existing chains. So examples of native currencies are Bitcoin, which has its own unique blockchain, and Ether, which also operates on its own unique blockchain. But then we get a whole host of different types of utility tokens, which are built on top of existing blockchains. So they essentially piggyback off of the existing decentralization that these blockchains have achieved, and they create a specific value token that follows a specific set of rules, or gives access to a specific service or platform, and that's where their value derives. But the decentralization of those tokens actually comes from the underlying blockchain network. Right, and cryptocurrencies can be said to have been around since 2009, which was when Bitcoin started, but the vast majority emerged between 2014 and 2017. So the space is still very young, it's still very emerging, and it is still difficult to differentiate between real demand, fundamental demand for these assets versus speculative demand. But if we simply take a snapshot of their lifetime to date, there is more than enough evidence to show that there is rapid increase in adoption of these networks. And as a result of that increase in adoption, there's also massive potential for huge investment returns. So the graph that I have shown here, that I put together, is quite simply a comparison of Bitcoin over the last 5 years, or Bitcoin's 1-year return, 2-year return, 3-year return, etc., measured against Tesla, Amazon, S&P 500, and JSE. Over the shorter time horizons, you can see that Tesla is actually quite competitive. But once we jump to a 5-year time horizon, you can see that Bitcoin far exceeds the performance of those stock markets. Almost 4 times the growth that Tesla has seen. And Tesla's growth in itself has been quite unprecedented. Okay, so another snapshot of the market to date. I've taken the market caps of the three largest cryptocurrencies as of today. That's Bitcoin, Ethereum, and Cardano. And from close to zero significant market cap in 2016, these are now currently worth $1.4 trillion, which is an enormous amount of investment. If we extend our data to include the entire crypto market, it comes closer towards a combined market capitalization of $2 trillion. And this is in a very, very, very short space of time. Now, there is this massive demand and there's this massive excitement and people want exposure and people want to invest. But the major problem is that there is no regulation. And this is not, it's not something new. Regulation always has to follow innovation. We even see it in traditional markets. Companies such as Uber is a good example of that, where they were not regulated or illegal in many of the jurisdictions when they launched. It was the regulation that eventually had to catch up to the technology of Uber and what their product was. So this is not a unique situation to cryptocurrencies. It happens with every technological innovation. So it is still very early. There aren't many educational resources. There's no accreditations, but that gap is starting to close, and we will eventually see that closing. Now, although there are no explicit regulations that deal with cryptocurrencies and crypto assets, there is implicit guidance that we have received from many of the regulators. And these are freely available. You can log on to each website and you can see their statements there. And it at least gives a framework in which we can handle these assets and treat them from a tax perspective. So, Saab, what does the Reserve Bank have to say? In their 2014 position paper, which is already quite old now, but it is still their current stance, they're of the opinion that it is not legal tender. It falls outside of their regulatory mandate, so that they have they're not required to output any new regulations specifically pertaining to crypto assets. However, there is one point that they make explicitly, and they make the point that crypto assets cannot be used to avoid exchange controls. And that is quite clear from their position paper. Secondly, we have SARS. SARS's latest update was in April of 2018. And again, it's quite clear, and it offers a good framework for investors to understand how to treat these assets from a tax perspective. So from SARS's perspective, it's regarded as an asset of intangible nature. They apply normal income tax rules to gains or losses, and the onus sits with the taxpayer to declare these gains or losses wherever they may arise from. In certain very rare cases, it may be arguable that gains from investments can be taxed as CGT, but this is extremely rare, and the vast majority is accounted as part of the revenue account and taxed as income. Now, the IFWG, that might be a new acronym to most of you, stands for the Intergovernmental Fintech Working Group. It's a new body that was put together specifically to look at technological innovations and to answer the question as to how they should be regulated. This group consists of members from National Treasury, the Reserve Bank, Financial Intelligence Center, and the FSCA. So they have released two working papers, as far as I know, or two policy recommendations, and the vast majority of their recommendations are extremely warm towards cryptocurrencies. It discusses in detail how they believe it should be regulated, how it falls into the current regulatory structure, and what they believe it should look like going forward. So there's no discussion of banning or outlawing cryptocurrencies. That doesn't seem to be on the horizon at all. What is on the horizon is standard, sensible regulation, and most likely a specific license category that deals with crypto assets. The jargon that they use in their policy recommendation is a CASP, a crypto asset service provider. And that's what we believe will eventually become the licensing category. Now, the most recent notice that has been sent to the market is from the FSCA, and that was from November of last year. And it's following directly on from the IFWG's recommendations. In their notice, the FSCA, or the purpose of the notice from the FSCA was to give partial effect to those policy recommendations. It classifies crypto assets and cryptocurrencies as a financial product and subjects their treatment to the existing law under FACE. Okay, and they also mentioned the intention to eventually create a specific license category, which will provide a lot of clarity and a lot of certainty to the market. So although, again, as we've seen, although there is no explicit regulations relating to cryptocurrencies, there's more than enough guidance to give investors direction and comfort in understanding how they should handle these and what is the correct way to go about it. Beyond regulation, there are still a plethora of other risks which are prevalent in this market. Because it's so new, because it's not widely understood, because it's a very technical subject, there's still a lot of difficulties in dealing with cryptocurrencies. Simply knowing where to go to purchase them, which platforms to trust, how to transact, how to store cryptocurrencies. These all require a large amount of time to put in, to learn, to understand, to avoid making errors. So that is still a very huge risk in this. Our data suggests that over 20% of cryptocurrency losses have simply come from user error. So that might mean someone forgetting a password, incorrectly putting together a backup. And as soon as one of these mistakes are made, those assets are lost forever. There are no safeguards in this market. There's no ombudsman to call to say, I sent my Bitcoin to the wrong address, or I pressed a 3 instead of a 4. So those handling risks are still very prevalent, and we still see large amount of losses as a result of those errors. There is also a large amount of market risk, and I think the market perceives cryptocurrencies as being extremely risky and extremely volatile. And that is certainly true. It's a very new market. Demand can fluctuate. Demand can be very fickle. But over the long enough time frame, you can see that demand is trending upwards and adoption is trending upwards. And that's why we are seeing so much growth in the market cap of these assets. There's still also a large amount of technical risk that one needs to consider. Historically, hacks of exchanges and exploits in smart contracts was very, very prevalent. They are still prevalent today. Just this year, we've seen a local exchange go insolvent, Ice Cubed or Ice 3X, that happened earlier in the year. And there's still a large amount of what I like to call second layer scams. So people and platforms that use cryptocurrencies to attract demand, but they have no actual product or anything or any service to offer. And people do unfortunately get caught by the MTIs and the Africryptos of this world. And again, that's as a result of lack of regulation and a lack of maturity in this market. So we need to solve for these problems. There needs to be avenues where investors can turn to have safe investment and good considered exposure into this market. So if we can navigate the regulatory environment, if we can mitigate the risks that are prevalent in the market to a sufficient extent, the question then arises, what do we invest in? And again, there is so much innovation and so many new tokens coming into the market and new ideas that it can be overwhelming, and it does turn some people away. And there's a ton of buzzwords that are being thrown around. Things like DeFi, dApps, CBDCs, proof of work, proof of stake. And, while at first it may be daunting, but once you whittle all of these terms down and peel away the top layers, they aren't that daunting, and there are frameworks that one can put together to decide where they want to invest and where they see the value arising in this market. It can be quite easily analogized to the early internet days, tech bubble of the late 90s, early 2000s. I think the average investor, even today, wouldn't be able to choose between Yahoo, Google, or Alta Vista. How would you have known that Amazon was going to be the largest company in the world instead of pets.com? So we see in any new market that's emerging, where there's a new technology and it's not very well understood, it's almost impossible to pick out the winners and the losers. But what we can tell for sure, and we can simply look at history and look at previous markets, is that an investor with a considered portfolio, possibly a diversified approach, would have done extremely well and would have done far better than the investor that completely stayed outside of the market. So what are some of the ways to deal with the market risk? Again, there are very good tactics and very good frameworks that can be used to mitigate a lot of the risk and get the favorable exposure to the upside. Now, anything new that is not understood very well and attracts huge demand and sometimes FOMO, etc., we see the potential for enormous growth. And I think my yearly chart showed that earlier, that Bitcoin has outperformed stock markets by orders of magnitude. So there is that potential for huge future growth. But there is the added risk that we went through earlier. So how do we deal with this? I like to call it the rule of 1%. The graphic shows an example with a portfolio allocation of 2%. But the basic thesis is quite simple. If you see potential in a market and there is that large upside with a lot of risk, you simply allocate a manageable amount into that market. So if you invest 2% of your portfolio, you cap the maximum potential loss. If it turns out that the investment goes sour or the market does not live up to its potential, or it disappears altogether, you've capped your maximum loss at 2%, which is very manageable for most investors. However, if the market continues to grow at the pace that it has done, and historically we've seen 200% per annum, you do not want to be left out of that market. So even a small allocation of 2%, if you see a large amount of growth over a couple of years, it then becomes a very significant and very valuable portion of your portfolio. Now, obviously at Jaltech, we've been thinking about this a lot, and we are working on producing these products and services that we can take to the regulated market. Our current solution is our regulated crypto notes. We believe it's the first of its kind in the country, and it offers investors a regulated avenue to get exposure, early exposure into this growing market. We offer three flavors of crypto notes. There's pure exposure to Bitcoin, we have pure exposure to Ethereum, and we've also developed a large cap index, which is a diversified bundle of some of the largest cryptocurrencies that are in the market at the moment. The beauty of the note, apart from simply being regulated, is it removes all of the complexity and the difficulties with handling crypto assets. It's a bundled product. It has professional execution and institutional grade custody completely built in. So there's zero complexity, doesn't require any work or any technical understanding from the investor's point of view. So that brings us to the end of my presentation. I hope it was a worthwhile introduction. I hope you have an understanding of what a blockchain is, and you maybe feel more comfortable and understand how they work and what the potential possibilities and value propositions are in this market. I have my email address on this final slide. So if you have any inquiries or would like to schedule calls to discuss further, please feel free to contact me. And you can also visit our website, jaltech.co.za. There is a section in there that will show all our upcoming webinars. So if you'd like to keep up to date with future webinars where we maybe take a deeper look, you can do so via our website.
Thanks, Andoni, and an excellent and very, very well articulated overview of the cryptocurrency ecosystem. I'm going to start inviting some questions. I see we have a couple. First question, how does one become accredited to market the debenture note? That's no doubt from an IFA. And the second question is an easy one. What is the minimum investment that will be into the debenture note? That's 10,000 Rand is the minimum investment. How does one become accredited? Not to show who's asking this, anonymous attendee reminds us of the old days in the life insurance world where we used to have tests and then mark them. What we're doing at Jaltech is we're going to be running a series of workshops. So at the end of September, the invites are actually going out today. We are inviting all advisors and their teams who we've engaged with to attend these workshops, and then we are running another 2 workshops at the end of October. We may put an exam of sorts together, but certainly the information that we share with you in the workshops and our full due diligence pack and the brochures that we've put together are full of information, and we'd like to think that we will get you up to accreditation standard. And Joni, do you want to comment on that?
Yeah, sure. So there's no official accreditation as yet. Can't claim to have that just yet. But in the guidance that we've received, specifically for the debenture notes, it falls under license category 1.10, which I think is debentures and debt securities. But it comes with a caveat that you are required to have a minimum knowledge of the underlying assets, and the underlying assets being cryptocurrencies. So there is no official accreditation, and that is up to interpretation as to what a minimum understanding is. But exactly as you said, the purpose of these webinars and future workshops will be precisely to do that for advisors, to level up their understanding so that they can demonstrate a minimum knowledge.
I've got a question for you, Andoni, while we pause. Can you maybe comment a little bit more about the working group and some of the insights that you have on what they're doing and the progress that they're making?
Sure. So I would definitely recommend guys that are interested to go and actually read that full policy recommendation. But essentially what they're trying to do is they're trying to bring cryptocurrencies under the existing framework. And it's both from a local perspective and a global perspective. So that financial institutions can actually communicate and share information. And I think really the comforting thing for me when reading that is that cryptocurrencies already fall into classification as a financial product, and that is how we treat it at Jaltech. And the only kind of gray area is that it does not have its own license category and its own explicit category. So I think that will eventually come. That's definitely where things seem to be tilting towards. But yeah, the group, it's multi-governmental and it's multi-institutional. As I mentioned earlier, it's made up of members from National Treasury, the Reserve Bank, Financial Intelligence Center, essentially all the governing bodies that look after the financial sector. So yeah, we believe it's just a matter of time, and we're hoping to see more clarity Q1 of next year.
Another question for you from me, Andoni. I'm quite keen to get your views on the change you've seen in the last 5 years. On the back of my statement I'm about to make, the change I've seen in the last few months is I've seen many advisors move from quite indifferent really to cryptocurrency as an asset class, certainly to quite high enthusiastic believers who are very keen to get education. And that's the space we're filling. We want to educate advisors as opposed to sell product. And on the back of that education, we believe that advisors will take the conversation to their clients. And Donny, the change that you've seen over the last 5 years?
Sure. So yeah, 5 years ago, I think it was definitely the Wild West. There were almost no institutions that would go anywhere near it. It was all retail, all individuals. All the trading platforms were completely unregulated. Very, very untrustworthy, very difficult to get information. So it was very murky, and it was small enough to be ignored, especially by the institutions. But as the market has matured and grown, we've seen the serious players grow in market share and seek regulation voluntarily. We've got two great local examples in Luno and Valo, who I think are actually two of the best platforms in the world. We've now got a listed exchange in the US, which is Coinbase. So these companies are growing, they're extremely profitable, and they want to be legitimate and they want to be regulated. And they are pushing that drive. So over time, as the market has kept growing and kept showing massive returns, now the institutions are starting to sit up and say, okay, we can't ignore it anymore. We need to have exposure here, and we need to be able, we also need to be able to offer products and services in the space. Where do we go to get that? So now from just being retail, we're now seeing a lot of institutional demand, and institutions are able to purchase, and they're putting it on their balance sheets, and they're finding ways to treat it from an accounting and a tax perspective. And it's all completely legal. And so it's very positive in that sense. The regulation is still a bit behind in many parts of the world, but it is catching up. And there's a lot of interesting cases all over. Some, as I mentioned in the presentation, SARB specifically classifies it as not legal tender here. But we see a small country like El Salvador, who in the last couple of months has done the opposite view, and they've made it legal tender. So there's a lot of interesting developments that are taking place, but overall, we keep seeing adoption growing and demand growing, and that's been the overarching trend throughout my time.
And Donny, given that the debenture note rewards the investor who holds for 3 years or more, share with us your views on investors who trade in crypto and try and buy the dips and sell out in the peaks, versus those who have taken a buy and hold strategy.
Yeah, sure. I mean, it's two very competing attitudes. And I think for a trader, the volatility is great because there's tons of opportunity. But myself personally, I think trading is extremely difficult. It's not for everyone. It turns into a full-time job in itself. And one mistake has the potential to wipe out all your gains. And especially a lot of people don't appreciate with cryptocurrencies is it's a 24/7 global market. It's not the stocks that switch off at 5 o'clock at night, and then reopens at 8, and you can have a dawdle on a public holiday, etc. These assets are moving and they're volatile 24/7, 365 days a year. So in that respect, yeah, it's there's opportunity, but it's very risky, and I don't think it's for most people. Now, the opposite end of that spectrum, the buy and hold strategy, to me, I think it's optimum because there is still so much that can change. I think if you take a snapshot of the top 10 cryptocurrencies from 10 years ago, and then compare it to 5 years ago and compare it today, there's probably only 2 that are still the same. Maybe 3 if we include stable coins and we look at Tether. So if you see potential in this market, but you aren't particularly confident in picking winners and losers and saying, I'm sure that there's going to be success in this network or that blockchain or this currency, I definitely think a longer term view is where a vast amount of the value will eventually arise in this technology. And I think another good framework to use is if you look at S-curves of technological adoption, and this applies to any technology, something as simple as a washing machine or a cell phone or automobiles. You can look at the adoption rate of those technologies, and it starts off very, very slow. It's your experimenters, your early risk takers, etc. And then when the majority comes in, that adoption curve rises very steeply until it gets to 100% market share, and then it stabilizes, and then you've got no more volatility in the market. So I think if we look at it from that view, where we say this technology is definitely going to be adopted, we may not know exactly in what form and which blockchain is going to win out in the end, but there's value there. Definitely the diversified buy and hold is probably the optimum strategy.
Questions are starting to roll in, Antony. Shahid Peters asks, at what point will we be able to market the debenture note? I'm going to reinforce that question by asking you to explain the journey and the structuring that took place to bring this to market.
Sure. So it's marketable as of right now. We are open for subscriptions. And sort of the key design decision with the debenture note was to create a layer between the investor and the underlying asset. So through the note, you get exposure to the market and to the movements in the price, but you are not actually ever physically holding the asset. You're holding a debt note, and it's a debt note. That's how you treat it from your accounting and your tax perspective. You are never actually touching any of the crypto assets themselves. You're removed. We've issued it from a public company because we want to self-regulate as much as possible. So we're subjecting ourselves to regular audits, and we're trying to be as transparent as we can, because we want to wrap this product in as much regulation as possible to give the investor peace of mind and recourse if something were to happen.
Right, here's a question that people are starting to tap into your expertise, Antony, and a question no doubt from a financial planner. How do we apply blockchain technology to our financial planning practice? Not investing in coins, but actually using the technology for my practice.
Sure. So I mean, it's a tricky one, because decentralization, its main advantage is it makes your system robust. So like I said earlier, if the government didn't want to shut down or wanted to shut down Facebook because it was spreading fake news or spreading propaganda or whatever it is, it's quite easy for them to go to Mark Zuckerberg, put him on trial, find his servers, shut down his servers, and close that platform. So decentralization is useful where you want a system to have strong rules that can't be changed by any one participant. Now, for your practice in particular, that may not be applicable because you are the person in charge. You are the single point of control in that organization. So unless you wanted to build a structure where you have input from many different principals or CEOs, and you don't want any one of them to have any undue power, then it may be possible to implement a type of private blockchain. But unless that's what you want, then there probably isn't a direct application for that type of business.
Waiting for people to ask questions. I've got so many that I can ask, and Tony, I want you to share the answer with the audience, because I find it so fascinating, your depth of knowledge regarding the biggest fear that investors have is of having their asset hacked and it evaporates before you. This whole concept of hot wallets and cold storage. Talk a little bit more about that.
Sure. So kind of as a theme, okay, we're seeing physical services and physical things migrating onto digital platforms. And, you can think of Facebook as like the, instead of socializing at the bar, you now socialize on Facebook. Instead of playing soccer outside, you log onto your PlayStation and you go. So everything is becoming digitized, and sort of the last step of that digitization is now value. So now, instead of value being a piece of information. So previously, where it's easy to conceptualize how do you keep your gold safe, you stick it in a vault behind guys with guns and a massive lock. That's simple. That's what we used to doing. Now I've got this Bitcoin and it's worth a lot. How do I protect it? How do I keep it safe? How do I ensure that I don't get hacked? And digital security is, again, a very complex space. And I think most people are sort of undereducated in that area. You know, and it's going to take time for people to understand, you know, how do they maintain their privacy online? How do they maintain, you know, keep information private that they don't want to be seen? So for an individual, it is very difficult to get over that hurdle and understand how to keep these assets safe. But what has been one of the best developments in the market is we've seen professional custodians and professional custody platforms, very competitive space at the market at the moment. And it's very sophisticated. And essentially what they've replicated is the same security you have in that physical bank vault that's got a man with a gun and a lot of locks. We now have that in the digital realm. So you can think of it as a digital vault. And it's becoming very sophisticated. The cryptography is very, very technical, but it has essentially mitigated the hacking risk almost down to zero. And these platforms are also able to implement similar policies that you would see on a normal online banking account. So if you are the treasurer or the CFO, you know, of a large corporation, you don't just sign off large transactions by yourself. It has to go through policy approval. It has to get intermediary signatures before it gets final sign-off. And all of these types of systems that we are used to in the traditional financial space are being replicated and built out in the digital asset space to such an extent that you can have as much peace of mind, you know, with your Bitcoin at the custodian as you can with your 10,000 Rand sitting in an FNB savings account.
Yeah, thanks for that, Andoni. So we have a question from Ash Sebastian. What is your view on crypto exchanges getting ADLA licenses to do offshore remittances? Secondary to that, does it have the ability to kill the legacy bank systems, in your opinion?
So I'm going to have to plead ignorance on ADLA. I'm actually not familiar with that acronym. But I'll speak towards the second part of the question. So does it have the ability to kill the legacy bank systems? Short answer is yes, it does have that ability, but I don't think it's an adversarial relationship. I think it's complementary in that it's a technology that makes transferring value much cheaper, much more efficient. And in large part, what I've seen is most people like to outsource their services. You know, it's everything's freely available. We have the internet now. Anyone with an internet connection can go and learn how to do all of these things themselves. But they either don't have the time in their day because they are busied with their own occupations, or they don't have the inclination to do so. And it's more convenient for them to use a professional. So I don't think it will kill the legacy banking systems. I think it'll be incorporated into them, and it'll be the efficiency gains will be passed on to the entire market. It'll make all those services far cheaper, and ultimately the consumer will benefit.
Did some Googling there while you answered that question. ADLA, authorized dealers in foreign exchange with limited authority.
Right.
Authorized by the Financial Surveillance Department to deal in certain foreign currency activities. I'm sure
so
many people in the audience were Googling that. So many new TLAs that have come into our life, three-letter acronyms and new words that we're having to deal with. Just some of the things that advisors have said to me in the over 35 engagements that myself, Jonty Sachs and Doni and Gaurav Nair from Jaltech have had. One has said to us, I simply have to get to know and understand this market, because the number one question I get every day is about crypto, and clients asking me for an opinion and what should they do. So I've decided to really get to grips with it so I can advise clients. And I'm sure that view is going to become a dominant theme. Another question has come up. That was just an explanation. Another observation from me is that the interest from institutions, that's the the banks, they've all got private client and wealth and investment suites, and the life insurers have got a private client division, wealth and investment. The interest is high. They have been engaging with the Jaltech team, asking lots of questions. No doubt they'll do their DD work. But the fact that the institutions are so watchful of what's happening in this space is a very, very good signal. And I always urge financial advisors, solo operators, partnerships to really embrace what's happening in this space. And Jaltech and the team will help you do that. I'm going to pause and ask if we can have the last few questions. It's no time to be shy. Here comes a question from Ian Bessarabia. What is your position on crypto arbitrage and how does it work? And what is the regulator's position on it from exchange controls perspective? Dodi, I know you've got a lot of depth to share with us here.
Yeah, so essentially the regulator's position is neutral or it's unchanged. Every South African has an 11 million rand allowance, 1 million being discretionary, the additional 10 requiring clearance from SARS before it can be sent offshore. But that's been applicable for many years and to every individual, and you can allocate that to however you want. So as long as the funds are cleared through an authorized dealer before they're sent offshore, then crypto arbitrage falls into that wheelhouse of what any individual can choose to allocate their offshore allowance towards. So yeah, it's actually one of our largest products at the moment. We've traded just shy of R1 billion on our arbitrage product. There were one or two kind of sticky situations where SARS kind of were unsure whether they would allow it, for certain individuals. But as long as our disclosures were upfront and submissions were approved, then it's kind of clear and an easy pipeline to keep trading that. So we don't foresee any issues with the arbitrage.
Another question from me, Andoni, and I'm surprised it hasn't come from the audience because the work that we've done in the field promoting the Jaltech suite of products, a lot of interest around the large cap index note. Andoni, just tell us a little bit more about the makeup of that note and some of the research and rigor that has taken place to ensure that we select the most appropriate suite to blend.
Sure. So yeah, I mean, things are very, very new and they're moving at light speed. And the technology is all very promising and all very interesting. So, from a zoomed out view, we don't know who the winners and the losers are going to be. But we want to be in the game. We want to have skin in the game. And so we needed a framework to select, right, what do we think is going to capture the value? And at the same time, we had to be cognizant of the risks that are still prevalent in the market. So what we've ended up with is a basket of 7. It consists of your digital gold type currencies. So Bitcoin, for example, everyone's familiar with that. And Ethereum, which is trying to be a platform for other decentralized applications. So it's essentially the gas that all these potential applications will run on top of. And then there's some other interesting chains, Polkadot, which is trying to be a conduit between separate chains, so it can facilitate value transfer between disconnected chains. Then there's a competing platform called Cardano, and then we have these tokens, Uniswap, RV, Chainlink, which are these decentralized platforms. One is to facilitate swaps, the other facilitates lending and borrowing. And Chainlink is an interesting one where it aims to be a decentralized oracle. So essentially it takes real world information and puts that into the blockchain. So it's kind of a bridge between the real world and the digital world. So how did we land up with that basket? Our first criteria was a minimum market cap. So we needed to see some sort of minimum investment, and some sort of track record and history in these networks. So we looked at every single cryptocurrency that had more than a $2.5 billion market share or market cap. And then from there, we evaluated it against our additional criteria. So step one was remove all stable coins. There's no real investment case to stablecoin. So those were taken out. Any other derivative type tokens like a Bitcoin offshoot, etc., we would also remove because we don't believe that the forks really capture any value in themselves. We then looked at security. We needed to be sure that there were no vulnerabilities in the code base or in the blockchain itself before we included it. So we wanted it to be secure. We evaluated it against liquidity, which is super important because we need to be able to actually purchase the asset and then redeem it once someone wants to utilize the those notes. So very important. Lastly, we considered decentralization and regulation. So there needed to be a minimum amount of decentralization in these networks, because what we're actually seeing, and even in some of the largest cap coins, companies like XRP or Ripple and Binance, the company is too ingrained with the network itself, and they are subject to legal action themselves. So to us, that's not a sufficient level of decentralization to allow incorporation into the index. These criteria are constantly assessed and evaluated. So if the scenario changes where a token now does meet the criteria, we would include them, and vice versa. If a token suddenly falls short of our assessments, we would then exclude it from the index.
Thanks, Anthony. Little wonder why there is so much interest in this large cap index note. We have another question from Ash Sebastian. Will fund managers for alternative assets provide call options for SA clients?
Absolutely. I think more and more structured products are going to be coming into the market at a rapid rate. And, there's also in our engagements, we get a lot of questions I don't want to invest in the underlying directly, but if you had a capital guaranteed note or some other type of structured note that suits their particular needs, that would be something that more investors would be willing to go for. So I think we're going to see sort of an avalanche of structured products coming into the market in the coming years.
Seems as though the questions are drying up. I'm going to just pause for a few seconds and urge anybody who's got that question, that burning question that they want to ask, and we'll deal with it. Just share with you all a story. And Tony, remember on our call yesterday, we got absolutely interrogated. We ended up having a 30-minute meeting that went on for an hour and a bit with an advisor, asking really great questions because his clients are asking him these questions. And after the meeting, he gave us the catch-all, which was, Andoni and Mike, what questions should I have asked? Can you remember what your answer to that was, Andoni? Because there's a lot of stuff that people don't know that they don't know.
Yeah, I mean, I do remember what my answer was. I don't know if it's appropriate for this forum, but no, you know what, I think one thing that professionals struggle with as well, especially in this market, is how do you value these assets and what kind of framework do you put on them? And they are very different in that they don't it doesn't yield anything. It's not like a traditional debt note or a stock that pays dividends, so the market is trying to figure out where does the value come from. And again, I think the more you just filter it down to its basics, and what is the use case for these assets, and are people actually using it in the real world, and is demand going to grow? I think there's the answer. And I think the best way to sort of model valuations in this space is to try and quantify what you think the demand is going to be today, tomorrow, next year, and in 20 years' time. because that's essentially what's going to drive the price.
Good. Thanks for that. No more questions that have come through. So as I said that, a question came through and we're going to have a look at it. From anonymous attendee, which current projects are applicable in the real world? I'm quite sure what is meant by that question. Which current projects?
Yeah, I mean, I think I would say all of them, because it's an experiment and these tokens are being launched and people are seeing, is there a market for it, and does it need to be decentralized? Some of these tokens might end up going to zero and we revert to the centralized alternatives. But yes, the simple answer is yes. Anyone who uses Bitcoin either to invest or to send payments offshore, for any of those use cases, or anyone who uses Ethereum, or anyone who uses Arby to go and get a flash loan, so that they can put it on a futures market, and anyone who's doing that is using it in the real world. There is a debate as to how much of it is fundamental, purely speculative. I think it's both, and I think both of those exist in all types of assets. People get a connotation on the housing market because people use it as an investment and then build up speculative bubbles, and then the housing market crashes. No one looks at a house and says, oh, a house is a scam or a this or a that. But for some reason, they tend to put those labels onto crypto, maybe because it's not very well understood. But anyone who's using it right now, and for any of those reasons, is a real world use case.
Good. Another question came through right at the death as I was about to wrap up. Again from Ian Bessarabia. How do we filter fact from fiction? In other words, what are the best sources to keep updated on these projects you have been speaking about?
Sure. Yeah, that's a tough one, because one of the wonderful things about the internet, when everyone said it's going to democratize knowledge and information and everyone will have access, the flip side of that people didn't realize is that it's going to be filled with lies and misdirection and fake news. So it is difficult to filter through the rubbish, for lack of a better word. It really depends on what's informing your entry into this. Are you you want to learn about the tech and the technicals of how it works, interested from a financial point of view, want to look at it from a philosophical or a social point of view, because all those three aspects are quite widely line, and a lot of great books that I suppose I could recommend. But maybe that's a good idea for the Jaltech website. We can have a resource, and we could do that work beforehand. Filter, that would be a good place to direct people.
Great question, Ian, and great answer, Andoni. Thank you to all the attendees.